Let's take a look at oil, because oil consumption is tipped to peak no sooner than 2040, even if the Paris Climate Agreement is implemented. That's according to the outlook of the International Energy Agency, the IEA. Well, this prediction goes against what many in the industry believe, such as the CFO of Shell, Simon Henry, who predicted that supply could peak within 5 to 15 years. So who's right? Well, for his thoughts on this story, I'm joined on the line by Tom Burke, who's the chairman of E3G, third generation environmentalism. Tom, a very good day to you.
Good afternoon.
Hi. What's your take on this report?
I think it in effect reflects the reality that we're going to see a very volatile future for the oil price as the sort of cycle of investment slows down, and that works through in prices. But into that gap, I think we're going to see far faster acceleration of deployment of renewables than the IEA is currently projecting. All their previous projections for the rate at which the cost of renewables will go down and the uptake of those renewables will go up, they've all enormously underestimated the take-up of renewables. The same is true of storage, the cost of batteries and the way they're going down. So I suspect that the long-run future for oil is going to be closer to Simon Henry's view than the IEA's view.
Which is quite extraordinary, really, because not many people would have actually thought that somebody who heads up, or is at least a key player in an oil company, would actually say, well, do you know what, demand for our product will sort of tail off between 5 and 15 years.
Yeah, there is a wrinkle that you need to be aware of in Simon's position. Shell is now mostly a gas company. I mean, more of its product is gas than oil. And so what you're really looking at is what's going to happen to petrol consumption, because the bulk of oil is used in transport, and the high value piece of that is in petrol for vehicles. And I think what we're going to be seeing is a race between, as it were, Elon Musk and the oil companies for how quickly we drive forward with electric vehicles. And that, if that takes out the top end of the barrel, then it's much more likely that Simon Henry will be right than it is that the IEA will be right.
Yeah, but clearly that if that forecast holds true, then it really is putting pressure on the oil companies, the other players in the field, to have their wake up and smell the coffee moment, unless this is it.
I think you're absolutely right about that. And I think what is very important to bear in mind is if Simon Henry is right, the consequences for everybody are quite dramatic. We get in Britain 60-odd billion a year in tax revenues from the oil and gas industry, and we get about 20% of our pension fund dividends. So you would begin to see an impact over that time frame. You'll begin to see an impact on those revenue flows and tax flows, and we need to be pretty thoughtful about how we replace them.
And certainly, if we take Simon Henry's forecast, then that really does appear to suggest that certainly oil prices will fall under phenomenal pressure. We've actually seen that this year, how oil went from three-digit growth around 2015, before that, in fact, to where it is now, registering about $45 to $50 a barrel. So if it begins to deplete, I mean, where can we see prices being when we actually look forward? Can we actually have a return to those three digits?
I doubt. Well, you could get spikes when the price goes up, as in a sense, you've got the underlying transition out of oil is going on, but especially if interest rates go up and the world continues to be pretty turbulent politically, then you're going to see a deep reluctance to invest in the kind of projects that the oil companies run, which are highly capital intensive, very long life projects with a big gap between spend starting and revenues coming in. I think there'll be a real lack of appetite for those kind of projects. Renewables are going to look much more attractive because they're much lower capital intensity. You can do them on a much more modular scale. So in terms of capital allocation, it's easy to see how in these circumstances, very high volatility and political turbulence, investment in renewables doesn't only look more attractive from an energy or climate perspective, it also looks more attractive from a kind of financial security perspective.
And given the pendulum swing as well, we shouldn't forget that that move away from oil, it does have geopolitical ramifications as well, particularly for the likes of OPEC.
Well, I think that's exactly right. Mr. Putin is pretty dependent on oil revenues for sustaining his popularity at home. I would be more concerned about what we do about countries like Mozambique or Egypt, for whom a gas resource is a very important part of their sort of ability to generate revenues going forward. So you're absolutely right. There could be very significant geopolitical consequences if we don't think through how this is going to work and what else we need to do other than sit in our cars and take advantage of low petrol prices.
Of course. And I mean, look, in the introduction, I mentioned there the Paris Climate Accord, negotiated, in fact, in December last year. So where does this fit into the jigsaw puzzle? Because they set emissions targets. And, of course, there are concerns as to whether America can fulfill those targets, given the change at the White House next year and Donald Trump's own scepticism about climate, global warming.
Yeah, I get that. I think that is important. I think the thing to remember is Paris marked a really significant turning point in the whole debate on climate change. Really what's happened now is the political risk to governments of not doing something on climate change are growing, and the political risks of doing something are falling as the cost of renewables falls. So you have more extreme weather events, more of the effects the scientists have predicted occurring, putting real pressure on governments to do something. Meanwhile, the costs of doing something are going down. And then, if you like, what's happening up until Paris, the regulatory push was the thing that was driving us towards a lower carbon economy. But what I think we're beginning to see now is a much stronger opportunity pull. Now, Mr. Trump can maybe slow down the regulatory push, though probably not as much as he thinks. But he can't do anything to stop the opportunity pull. So what you're seeing is the Elon Musk, the people with better technologies really coming in. And if you think about the IEA projections for the oil going out to 2040, well, 60% or more of the fossil fuel use is waste heat. Now, to start a company like Uber or Airbnb, that's exactly the kind of thing that looks like an opportunity to eliminate that waste heat. And I think we're going to see a lot more creativity in that sort of area.
Right.
So I think things will happen faster, and the opportunity pull will become increasingly important as we go forward.
OK, Tom, we have to leave it there. An absolute pleasure speaking to you. That was Tom Burke, who's chairman of E3G, giving his reaction to the IEA's latest oil report, basically saying that oil consumption will peak no sooner than 2040, although that view puts them in collision, if you like, with the chief financial officer of Shell, who predicts that supply could peak within 5 to 15 years. A debate which will go on, I'm sure, for some time.